Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're breaking down why Apple and Facebook stock look kind of strong after they both posted some solid quarterly earnings results last week. And we also previewed both of those companies last week here on this show. So it's a good follow-up episode to see some of those results and what we expect now in that holiday quarter and going forward. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcasts@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And before we jump into Apple and Facebook, I quickly wanted to mention that U.S. stocks jumped to new highs Monday as Wall Street and investors become more optimistic about this quote-unquote Phase 1 U.S.-China trade deal, along with better-than-feared earnings results, another Fed rate cut last week, and some solid U.S. jobs data that came out. So the Department of Labor said last Thursday that the U.S. economy added 128,000 jobs in October, which easily crushed their estimates from economists that were calling for only 75,000. So a big number there compared to estimates. And the jobless rate did tick up slightly to 3.6% from 3.5% in September, but they still sit near 50-year lows heading into this, as I mentioned, holiday shopping quarter, which is often a big one for retailers, which is why we're going to start with Apple, which also hit a brand new 52-week high Monday morning of about $258 per share. AAPL stock is now up 13% in the last month, 63% in 2019, and this is against the S&P 500's 21% climb. And Apple, just for a longer frame of reference, is up about 50% over the last 2 years. And here's what we know about Apple at the moment, and we're going to then do a little bit of a quick Q4 overview before we see what's coming down the pipeline. So the past year, for those who've been paying attention, has been rough for Apple in terms of iPhone sales, which remains its largest business unit. In fact, the company's flagship smartphone sales did fall 9% this past quarter. This, however, marked an improvement compared to the first 3 quarters of 2019, when iPhone sales fell an average of 15% from the year-ago periods. Meanwhile, sales in Greater China also fell in 2019, down about 15% for the year, but Wall Street has remained behind Apple amid these downturns because it's also coming up against hard to compare periods. For instance, iPhone sales were up 29% in Q4 of last year. So it's not just that iPhone sales are struggling, they're struggling against really impressive sales in 2018. And the firm also likely is to return to growth in these key areas down the road, which we're going to get into in a little bit. So despite these disappointing iPhone sales and sales in Greater China, Apple's overall fourth quarter sales, which is the quarter just reported, climbed 2% to top our quarterly estimate that called for a slight downturn. So a solid top line beat there. And then Apple posted back-to-back quarters of positive sales expansion to end the year after Q1 sales were down about 5% in both Q1 and Q2 were down about 5%, 5.1 and 4.5 for those first 2 quarters of fiscal 2019. And then at the bottom end of the income statement, Apple's adjusted quarterly earnings climbed about 4%, which also easily beat our estimate, which would have actually marked a decline if it came in at our estimate. So all said, Apple's full year earnings slipped marginally and revenue dipped about 2% for 2019. So that's the brief Q4 overview and a little bit of a 2019 recap. So now I want to take a look at kind of what's next and talk about a business that Apple has been hyping up for much of the last several years to draw Wall Street away from the fact that eventually iPhone sales are going to become harder and harder to grow on a year-over-year basis. So, along with Apple's better than projected top and bottom line results, investors narrowed in on the company's services business, which includes sales from its App Store, mobile payments, its Spotify challenger, Apple Music, and more. So, the company's services unit climbed 18% in the quarter to account for roughly 18% of total quarterly revenue, and it's now easily the company's second largest business behind the iPhone, which is about 55% of Apple's total business in 2019. And CEO Tim Cook said on the company's conference call that Apple is on its way to its goal of doubling its fiscal 2016 services business during this fiscal year 2020. To do this, Apple has slowly beefed up its portfolio of services in recent years and in recent months. So in just the last couple months, Apple has rolled out a credit card along with the help of MasterCard and Goldman Sachs. It has a new video game service called Apple Arcade. And overall, the company CFO said on the call that they now have 450 million paid subscriptions across its services on our platforms compared to 330 million just a year ago. So up 120 million in that stretch. And then they said they are well on their way to their goal of surpassing the 500 million mark during 2020. So that's how big that business is. And then we should note something that maybe grabbed the most headlines for this services business is Apple officially launched its streaming TV service, Apple TV Plus, on last Friday, November 1st. And it's $4.99 per month streaming service that's coming in far below Netflix and HBO and Amazon Prime Video. And that is because the service doesn't have much content at the moment. So they're trying to entice users to maybe consider trying Apple TV Plus, and it also will be free to anyone who bought a new iPhone or other qualifying devices for that full year. So Apple TV Plus will continue to draw a lot of interest from Wall Street and investors over the next year or so to see how they can compete, if they can compete against Netflix and soon enough Disney and all of these other companies who are really starting to dive into the streaming TV world all at once. And we should note, though, and I have not actually had a chance to watch any of these shows, even though I am going to get that Apple TV service for a full year. Some of the early reviews have been mixed on their two big shows, which is The Morning Show, starring Jennifer Aniston and Reese Witherspoon and Steve Carell. So this is one rating service that's actually become quite popular, is Rotten Tomatoes, which kind of brings together a bunch of different ratings from people who actually review movies and the audience. So for The Morning Show, at the moment, the critic score is at about 59%, but the audience score is up extremely high. Obviously, it's still early on, so 95% there, where it's post-apocalyptic drama C is at about 39% for critics, so pretty bad there, and 85% for reviewers. Just for a frame of reference, for those are their two big hyped shows that they really want to be successful for people to decide they're going to pay the $5 a month to watch these various shows. But I don't want to get too much into Apple TV Plus. We'll do a show later on and discuss Disney Plus and maybe more of the streaming market later on this year. So now I want to mention that along with services, Apple's wearable unit stood out last quarter. It was up 54%, driven by Apple Watch, Beats products, and those AirPods you see everybody wearing, those wireless Apple headphones. We should note that Apple just introduced a new version of those popular wireless headphones that are the AirPods Pro, which are going to cost a whopping $249. And the originals will now cost $159. And this is, once again, ahead of that vital holiday shopping season. And meanwhile, we should note that Apple Watch has been pretty successful. And this is part of the reason why Google just recently announced that it will buy Fitbit for approximately $2.1 billion as they try to compete with Apple Watch in that wearables market. So now looking ahead, executives at Apple are confident in both the short and long term. This includes iPhone 11 sales and its highly anticipated 5G rollout, which is expected to come out in September 2020, so a year from now or so. So this is a quote from CEO Tim Cook on the earnings call. Quote, "We are very thrilled with what we're seeing in early going on iPhone 11 and iPhone 11 Pro and Pro Max. It's early, but the trends look very good." So I don't want to make a long-range forecast here. We've put our current thinking in guidance, and you can tell from the guidance we are bullish. The gist of it is he's saying they're bullish. He's somewhat right based on what our numbers are saying. Well, not somewhat right. He's bullish. He doesn't want to get into too much details. He thinks their short and near-term future looks strong. So with this in mind, our current Q1 2020 sales estimates are calling for just over 2% growth. And then looking ahead to the full year fiscal 2020, revenue is projected to climb about 5.5% to a figure that would easily top 2018's really impressive strength. And then meanwhile, looking ahead to fiscal 2021, sales at Apple are expected to climb another 8% above our current year estimate to a whopping $296 billion in 2021. And at the bottom end of the income statement, Apple's adjusted holiday quarter earnings are projected to climb about 9%, with full year fiscal 2020 expected to climb about 10.5%, and then another 16% on the bottom line in 2021. So some positive signs on both the top and bottom line for Apple going forward. And overall, Apple is currently a Zacks ranked number 3 hold, but it has seen its earnings estimate revision activity trend more heavily in the right direction following last week's release, especially for fiscal 2021. AAPL also holds an A grade for momentum and a B for growth in our style score system. And as some might expect based on its impressive starts, or not start anymore, we're already in November, as crazy as it is, to 2019, Apple's valuation picture is somewhat stretched. It's trading at about 19 times forward 12-month Zacks consensus earnings estimates, which comes in above its 3-year median of about 16, but a little bit below its 3-year high. So nothing crazy on the valuation side yet. And another thing to continue to pay attention to, we alluded to it at the top, was the Phase 1 trade deal, is that Tim Cook remains in pretty constant contact with President Trump, and he remains confident in the larger picture of the U.S.-China trade war front. And so far, Apple's biggest products, including the iPhone, have stayed off of that dreaded tariff list, which will be really important going forward in this holiday shopping season. And also, as we mentioned, U.S. unemployment remains near 50-year lows, which is always good for big retailers heading into the holiday shopping season. And the National Retail Federation expects sales to be strong as well. We should also always remember, if you're thinking about buying Apple stock, it does pay a dividend. It's yielding about 1.24% at the moment. And it also, Apple has $100 billion or so in cash. It continues to buy back stocks. So you can think of Apple kind of as a solid bond that gives you the chance to see 60-some% growth in 2019 if you happen to buy it, therefore, on that big dip in 2018. So overall, we've talked a lot about Apple. It clearly looks like a strong, longer-term stock that has expanded its business far beyond the iPhone. So make sure to pay attention to that services business and that Apple TV Plus and how Wall Street receives it, and more importantly, are consumers actually buying that? So we're now going to transition on to another company that reported its quarterly results last week, and that is Facebook. Facebook, the social media company, topped quarterly estimates last week despite the ongoing political scrutiny that the company has faced. So we're going to do what we did with Apple, which is quickly review some of their Q3 results and then talk about what to expect going forward and some of these broader issues that are going to impact Facebook or possibly impact Facebook down the line. So Facebook's Q3 2019 sales were up 29%. This also topped our estimate, and Facebook's adjusted quarterly earnings came in 20% higher than last year and crushed our estimate on the bottom line. So some top and bottom line beats for Facebook right off the bat. But perhaps more importantly, Facebook's daily active users climbed 9% to 1.6 billion. And meanwhile, its monthly active users climbed about 8% to 2.45 billion. Excuse me, had to take a drink there. So what we should note is, based on this 9% growth for daily active users, 8% growth for monthly active users, that pretty much matched the first 2 quarters of the year's expansion in these vital categories. So impressive stuff for Facebook there, amid all of this negativity surrounding Facebook and CEO Mark Zuckerberg. And Facebook doesn't break out its specific platforms at the moment, but there's no doubt that its 2012 purchase of Instagram for just around $1 billion has proven to be a steal. And in fact, Facebook now expects that roughly 2.7 billion people use at least one of what it calls its, quote, family of services each month. This includes, obviously, its namesake platform, as well as WhatsApp, Instagram, and Messenger. And just for reference, based on estimates of world population at about 7.7 billion at the moment, that means Facebook is reaching about 35% of the global population on a monthly basis. So despite this massive reach, a cloud continues to hang over Facebook. As some people might remember, Facebook has been under fire in Washington for nearly 2 years now. Zuckerberg's company paid a historic $5 billion Federal Trade Commission fine this summer and still faces more antitrust reviews and scrutiny as part of kind of a larger U.S. government probe into big tech that will likely be around for some time now. And we should also note that the company's founder and CEO, whose name is pretty well known at this point to even most people who don't know anything about Facebook, Mark Zuckerberg, spoke in front of the House Financial Services Committee recently and was there to talk about Facebook's plan to jump into cryptocurrency. And regulators are not happy with that plan for various reasons. So this summer, Facebook announced that it planned to roll out a blockchain-based cryptocurrency, though roughly 1/4 of its original partners in that financial space who were going to go in with Facebook on this plan have already backed out. This includes MasterCard, PayPal, Visa, and some others. And it seems pretty clear that they're backing out because they don't want to deal with this political pushback from the U.S. government. And based on the Zuckerberg's when he was talking, it seems like no matter what, he still wants to try to go forward with this cryptocurrency plan, obviously unless the U.S. government says you will not be allowed to. But despite the pushback, he still seems like this is something he wants to do. But nonetheless, even if these plans fall through and they never roll out anything that looks like a payment option for people in the cryptocurrency world, that Facebook as its business stands at the moment, as we alluded to with that 35% of the global population, its business is really impressive. And we should note that Facebook, as Mark Zuckerberg kind of funnily said a year ago when he was speaking in front of Congress, that someone asked him how Facebook makes money, and he basically just said, "We sell ads, sir." And that is how they make 99% of their money at the moment. And the company is poised to really become even more important and invaluable to marketers and advertisers because, as I've mentioned before in the show, consumers are just becoming harder and harder to reach in a non-ad supported world, and this includes people paying for Spotify. So they're not listening to the radio. They hear no ads on Spotify. They're paying for Netflix. They see no ads there. They're paying for Amazon Prime Video. They see no ads there. They're paying for Apple Music. They see no ads. They're going to pay for this Apple TV Plus. They see no ads. Disney Plus, no ads. HBO, no ads. So the premise is people are becoming harder and harder to reach as they cut the cord and pay for services where they're not exposed to ads. So a place like Facebook and its Instagram and WhatsApp really is more valuable than ever for marketers and advertisers. And we should note that Facebook is projected to remain the world's second largest seller of digital ads in 2019. This is behind only Google, of course, and in front of Chinese e-commerce powerhouse Alibaba. Plus, the overall digital marketing or digital advertising space, and this is, I think, one of the more bullish points that anyone could make about Facebook, and obviously anything could happen on the political side, but eMarketer projects that overall digital advertising on a global scale is projected to climb from about 46% of the total ad market in 2018 to over 60% by just 2023. So a 15% jump or so in a 5-year period is what eMarketer is expecting for that overall global digital ad market. And investors should also note that Zuckerberg has been in the news recently, and this is from that cryptocurrency speech or testimony, that he's coming under fire for his decision to allow what they're calling uncensored political ads across Facebook's various platforms. Then, in a pretty straightforward act of we want to look like we're different than Facebook, CEO Jack Dorsey of Twitter announced that they would get rid of all political ads on their platform. It does seem like a little bit of suspicious timing, even though Twitter did come under heat for its role in all of whatever. I don't want to get into all the politics, but Twitter stock is already down 30% since it posted disappointing earnings results on October 24th. So maybe Jack Dorsey and Twitter see it as kind of a PR win to say they're going to do what Facebook isn't doing, since Facebook is kind of getting a lot of backlash in the media these days. But Zuckerberg actually spent most of his introduction on the conference call talking about his decision to what he continued to say over and over again was that he wants Facebook to be on the side of free expression. He noted that he doesn't think, or he knows that this could possibly hurt the company in the near term, but he continued to go on and on throughout the call, and especially early on, to discuss how he wants to be on this side of free expression. And he noted that companies, or these same ads, are being run on television, so he doesn't see why Facebook shouldn't run political ads. But as I said, I don't want to get too much into that, but that's just what investors need to know in general. This is the political debate that you're going to hear more and more through this 2020 election cycle. And Zuckerberg also noted that these political ads aren't necessarily, it wasn't like we don't want to lose business if we drop these political ads, which obviously would be a lot of money, but they estimated that it would be about 0.5% of their revenue over the next year if they decided to ban political ads. So clearly it's not, the only motivation is not money on that side. So now looking ahead, we know that they're going to remain in the news for kind of the wrong reasons, but the company still looks pretty strong. So looking ahead to Q4, Facebook, as some might know, makes roughly 50% of its money in the US and Canada, and nearly 25% of its money, which once again is all from ads, in Europe. So this is happening even though most of its actual user growth is now coming outside of these more saturated markets. But still, we should note that monthly active users in Europe jumped pretty significantly. So they jumped from 375 million in Q3 of 2018 to 387 million this quarter, or last quarter, and 2 million sequentially. And meanwhile, in the US and Canada, that user base climbed 5 million from the year ago period and 3 million from last quarter. So some positive growth despite all of this negativity around Facebook, that they're still able to grow their user base even in their most saturated markets, which are the US and Canada and Europe. And on top of that, another important metric for anyone who's interested in Facebook is their average revenue per user, which was up 19% in the quarter to $7.26 per user. So up 20% in that key metric. So now looking ahead, our fourth quarter estimates are calling for Facebook sales to climb about 23%, with full year 2019 revenues to be up about 26%. And then looking ahead, we are expecting that growth to slow down in 2020 just to 22% higher to get up to about $86 billion. So once you get into those bigger numbers, it only makes sense that it's harder and harder to have these massive percentage gains on a year-over-year basis. And this is something that Wall Street and traders have known was coming for some time. So it's nothing that's going to be shocking to see that their revenue growth slowly slows down. And then on the bottom end of the income statement, Facebook's Q4 earnings are projected to climb about 3.5%, even though its full year earnings are expected to dip as it continues to spend on improving security and other various expansion efforts as well. With that said, though, despite this, what we're calling for would be about a 16% decline in earnings for 2019. We're then calling for a 48% jump above our current projections next year. So a big return to impressive bottom line growth in 2020 based on our estimates. And like Apple, Facebook stock has climbed recently. It's up 9% in the past month. Facebook, also like Apple, currently holds a number 3 hold. And it's sports some impressive, an A grade for growth in our style score system and a B for momentum. And we should also note that the company's 2019 earnings picture has turned more positive while its 2020 estimates have come in slightly lower since it reported its results last Wednesday. But despite the fact that its stock is up significantly this year, 49% in 2019, 32% over the last 12 months. Facebook actually opened Monday still down about 7% off its 52-week highs, which could give the stock some room to run as we get deeper into the fourth quarter. Plus, for those who haven't been following Facebook much, its valuation picture has continued to remain solid over the last year as it shakes off that massive growth phase of its company. It's a much more stable company at the moment in terms of its valuation. Facebook stock is trading at about 20.8 times forward 12-month Zacks consensus earning estimates, which marks a discount against its industry's 26 and its own 3-year median of 23 and well below its high over the stretch of about 36. So it's trading at about 21 times, which is well below its industry at 26 and its own 3-year high of about 36. So therefore, anyone who can handle some of this political uncertainty might want to take a deeper dive and look into Facebook stock at the moment, because clearly there are signs that the company could remain very successful for a very long period of time based on its massive user base and how much harder it is for advertisers to reach consumers. But it could be a little bit of a struggle over as this political cloud remains over its head. So it's a hard decision for anyone to make. So if you're going to think about buying Facebook stock, you really got to do a much deeper dive there. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.